Nearly 2%. That's the dip Apple stock took today, sending ripples through the tech market right before their critical earnings report. Savvy investors aren't seeing a crash. They're spotting a potential entry point. This movement isn't just a blip. It coincides directly with Apple launching a new upgrade program, a strategic move that typically generates significant revenue streams down the line. What's wild about this is how short-term market reactions often overlook the long-term play, especially for a company with Apple's ecosystem dominance. For anyone tracking major market shifts for their own business or side hustle, these pre-earnings jitters around a tech titan like Apple are pure gold. It signals a moment of reevaluation, where the market tries to price in future performance against immediate perceived risks. Pay attention. This isn't about panic. It's about positioning for profit. Here's the real story. Apple's stock slide isn't an isolated event. It's a classic market reaction to uncertainty surrounding an upcoming earnings call. Major players on Wall Street start de-risking, trimming positions, which creates downward pressure. But simultaneously, Apple just rolled out an ambitious new upgrade program designed to lock in customers and drive recurring revenue. Think about it. A guaranteed stream of income from existing users, not just new device sales. This isn't just about selling more phones. It's about reinforcing their ecosystem, making it even harder for users to leave. For anyone building a SaaS business or a subscription service, this is a masterclass in customer retention and lifetime value. That upgrade program, while potentially causing short-term cost, is a long-term revenue engine. This is where market noise often blinds people to the strategic brilliance unfolding. Yahoo Finance reported this specific nearly 2% dip, highlighting the nervous energy before earnings. What this data point really reveals isn't just a price drop, but the predictable dance of institutional money. Major funds often rebalance portfolios pre-earnings, causing these temporary price swings, especially for high-cap tech stocks. They're not necessarily losing faith in Apple. They're managing quarterly volatility. Consider how often we see these pre-report jitters, only for a strong company to rebound post-earnings once the actual numbers clarify the narrative. This is the exact environment where smart money, those leveraging deep market insights, makes their moves. They understand that short-term fear can often present long-term value, especially when a company is simultaneously launching new revenue initiatives like that upgrade program. It's a textbook example of market psychology overriding underlying fundamentals. Here's what nobody mentions about these minor market crashes. They're not always about the company's health. Often, it's simply market makers creating liquidity or executing automated trading strategies that trigger these percentage drops. The real opportunity isn't in panicking, but in understanding how these events create buying windows. For your own business, this reinforces a crucial lesson. Building multiple revenue streams, like an Amazon FBA store, a high-value SaaS product, or a monetized YouTube channel, provides resilience against any single market dip. Diversification isn't just for stocks. It's the bedrock of a robust side hustle or entrepreneurial venture. So, your actionable step today. Research companies with strong fundamentals that have recently experienced a minor dip due to external market noise. Then consider what their core business model can teach you about recurring revenue. Don't just watch the market. Learn from its movements to fortify your own financial future. Hit that subscribe button for more insights into turning market signals into personal profit. Top-tier analysts aren't singing from the same hymn sheet right now. Major investment banks, like those presenting at recent Goldman Sachs tech conferences, show a clear split. Some strategists are doubling down, seeing this price movement as a buy-the-dip signal, pointing to Apple's sticky ecosystem and recurring service revenue streams that hit over $85 billion last year. Others, however, are flagging potential headwinds from increased regulatory scrutiny in Europe and the US, projecting slower growth in emerging markets. Their models predict a tougher Q3 for hardware sales, pushing down earnings forecasts by as much as 50 basis points. The smart money isn't just listening to one side. They're dissecting the arguments from both camps to identify where true alpha is generated. This divergence creates a classic volatility play, letting savvy traders profit on the swings. Across global markets, reactions to U.S. tech sector jitters are surprisingly diverse. While European indices might mirror some tech-heavy movements, Asian markets, especially in Southeast Asia, are often driven by different local factors and consumer behaviors. For instance, in a contrasting economic landscape, Vicky Digital Bank recently announced a prize ceremony for its Vicky Savings Win a Gold Horse Kilo program, awarding a special prize of 10 SJC 999.9 gold taels. This highlights how various economies stimulate savings and investment, sometimes through direct, tangible incentives like gold, rather than solely through equity markets. This localized approach to financial engagement means capital flows aren't always universally tied to Silicon Valley's performance, creating unique arbitrage opportunities for those paying attention to regional trends and currency plays. It's a prime example of how different markets operate on distinct value propositions. Cast your mind back to late 2018, when Apple delivered a rare revenue warning, citing weak iPhone sales in China. That event saw the stock plummet over 9% in a single day. Many wrote it off, declaring the tech giant's golden era over. Yet within 12 months, Apple stock had not only recovered, but surged well past its previous highs, propelled by robust growth in services and wearables. This isn't a precise one-to-one replica, but the pattern of an initial sharp drop, followed by a strategic pivot and strong rebound, is a recurring theme in Apple's history. Those who understood the underlying resilience of the brand and its ability to innovate beyond a single product line were the ones who truly profited. The lesson? Market noise often obscures the long-term vision of a company with strong fundamentals and a loyal customer base. Most people assume a tech stock dip hurts everyone, but that's far from the truth. The real winners aren't just the short sellers. They're the companies building complementary services or competing hardware. Think of the surge in Android phone sales or increased market share for companies like Samsung when Apple faces perceived challenges. Even more unexpectedly, providers of cloud storage and productivity software, which are platform agnostic, often see a user influx as consumers reevaluate their tech ecosystems. On the flip side, the biggest losers aren't just individual investors who panic sell. It's often the smaller, niche accessory manufacturers whose entire business model relies on a seamless Apple product cycle. Their margins get squeezed first, and their supply chain exposure becomes a massive liability. The ripple effect is far more nuanced than simple stock price movements.